Hi, welcome to a quick lesson on the accounting concepts and principles. And the accounting concepts and principles will form part of any introduction to accounting course. Okay, in the next few minutes, we're going to learn 7 accounting concepts. Every student, bookkeeper, accountant, MBA candidate must know and understand these concepts and principles if they're going to become proficient as an accounting professional. Essentially, if you study accounting, this is week 1, lecture 1, slide 1 stuff in your accounting knowledge journey. Okay, some background. Now, accounting information is used for decision making. Reports and other accounting information are produced so management, investors, creditors, the government or other stakeholders can take actions based on this accounting information. If you further look at it like accounting is the language of business. It's how you can communicate a business's activity over time or at a particular point in time. But if you consider every organization type, every organization size, every organization location, how can we all speak the same language and make the best decisions that we were just talking about? The answer to this is that accountants follow a basic set of concepts and principles whenever they practice accounting. All financial accountants follow these principles globally, and by doing this, they consistently achieve reliability, relevance, and comparability in the information they produce. And that's what we're going to be learning today. The 7 accounting concepts that you have to know if you want to be an accounting professional. Okay, so let's get to the first concept. And this is the entity concept. And this is when we focus on the accounting entity. What this means is that when we perform the act of accounting and present accounting information, we are presenting accounting information and measuring accounting data about a particular entity and that entity alone. Now, an entity is kind of an abstract sort of concept, but all it's really referring to is perhaps an organization or a section of an organization, like a department or a division. But the key idea is whatever entity you're reporting or measuring will stand apart and separate from every other entity, every other organization, and separate from individuals themselves. What you do is you draw a strict boundary around the particular entity, and you only do the accounting for your particular accounting entity. What this means is that when you present your accounting information, you don't have your data and resulting reports mixed up with other uncontrollable or irrelevant entities. So hypothetically, if you're reporting on the marketing department, you want people who are going to make decisions about your reports on the marketing department only to act on the marketing department information. You don't want outside entity information like the production department to have some of their particular data filter into your entity and thus have confusion and poor decision making based on the reports you produce. So that's the accounting entity concept. That an example again is instead of a department, I mentioned that you keep individuals and entities separate. Perhaps you're a micro business person and you run a home business and you have certain business expenses and you have business income within your particular home office. The entity concept tells you that you keep your business transactions, so your micro business transactions, separate from your personal life transactions. So if you're producing financial reports, you would only have financial reports on business revenue and business expenses in running that micro business, and you would separate your individual personal expenses out of those accounting reports. The second concept is the accounting period concept, and this is the focus on the accounting period. The accounting period is simply a unit of measurement. It's a time period. The idea is that the life of an organization is indefinite. Could be 1 month, 1 year, 10 years, or even 100 years, or even more for some of the older organizations that we have in the world today. So to get value out of our accounting information reports, we have to have some sort of set time period where we can make sort of comparison between report and report. There will be no, it's an extreme example, but if you were the chief financial officer of the Ford company, and this company been going since the early 20th century, it would seem kind of extreme to have one profit and loss report for the 100-year or the life of the period. You wouldn't have one profit and loss report from 1900 to 2015. That would just be impractical and wouldn't serve much purpose for decision making. So what accountants do is they break the life of an organization in particular time periods, and these are known as accounting periods. Often there are regulatory required accounting periods. So, for instance, if you're listed on a stock exchange, you often have to, I think you always have to produce an annual report if you're a public company, and you have to produce an annual report for your stockholders. But there's also internal accounting periods which you can set yourself. So, for instance, management often needs accounting data much more regularly than stockholders. So an accounting period for management reports may be monthly or even weekly. They may get weekly sales reports or monthly cost reports, and in that case, the accounting period is a month. The purpose is comparability between periods, so you're able to compare one period to the other, and having a beginning to a period, a middle to a period, and an end to a period. So it's not one long continuous activity. This adds to relevancy of your accounting information and allows better decision making when you have more timely reports. The examples that we gave are the annual reports for public companies or the monthly management reports for internal management. Alright, the third principle is the cost principle. And this is based around the idea that accounting value is based on transaction costs. Now, these may be historic costs, which is an important concept, or fair value costs, or fair value, which is another important accounting concept. And both of these, whether it's historic cost or fair value, is that we don't record transactions or values on what we think particular items are worth. We always base our values on financial transaction evidence. So if we're using historic costs, then we may use invoices or receipts to prove the value of our transactions and to prove the value of our expenses or assets. And if we're using fair value, then we may use verifiable valuation documentation if we're keeping values at fair value. It's important to note that we don't record transactions for items on what we think they are worth. Now, we may buy an item for $100, for example, and we may honestly believe that we've got an absolute bargain and that this item is really worth $10,000. Now, even though we paid $100 for it, we really think it's worth $10,000 and we got an absolute bargain. We would never record that transaction or the value of that particular item for $10,000 because we think that's what they're worth. We have to base it on evidence, and particularly the transaction that we went through, and use those values. What this does is by relying on transaction costs, we have an objective measure of value. It's not subjective what we think they're worth or what we assume they're worth. When there's a transaction occurs between knowledgeable, willing parties, there's a buyer and a seller, then we know that that's an objective measure of value. The seller thought it was the correct value, the buyer thought it was the correct value, and we have that verifiable cost to enter into our accounting information. This allows decisions to be made with more certainty. When we have this objectivity, it adds to the reliability of our accounting information, and with that reliability and certainty, then ideally our decisions will be better. An example talks about historic costs. Our example could be where if a business is buying an office building, we would have documentation about how much we paid for the office building, maybe $100,000 for the building, a very cheap building, in some parts of the world. And our historic, we would enter the $100,000 into our accounting information system or our accounting data. That's what we paid for it. It's what the seller thought it was worth. It's what we thought it was worth as the buyer. And we have evidence of that. The next concept, the fourth one, is the matching principles. And this is the idea is that we match expenses against the income they generate. Now, if we think of a business as a system, we can look at it like our expenses are the inputs into the business. So we spend money on things that go into the business, and then income is generated from selling the outputs. So we pull things into the business that cost money and there are expenses. We perform a transformation on those, and then we generate outputs which are later sold, and that is our income. And it's one system. And if we're going to get an accurate measure of profit, which is simply income minus expenses, then we need these inputs and outputs to match up, to line up against each other to get a true reflection of profit. And that's the greatest benefit of the matching principle. We do get a good measure of profit, which is just simply income minus expenses. For example, if we have cost of goods sold and inventory, so if we're selling widgets for $200 at our corner store, but the widgets costs $150 to stock, so we pay our supplier $150, we put them on our shelves, and then we sell them for $200. We want that $150 of the inventory to be recognized as an expense, which is cost of goods sold, at the same time that we sell the widgets for $200. So there should be $200 for income, $150 for cost of goods sold, which is our expense, and those two should occur at the same time. And that's an example of the matching principle. And by having those two amounts at the same time, we get an accurate reflection of profit of selling those widgets. Okay, the fifth concept, which is the profit recognition principle. And this is the idea that we only recognize profit or revenue, which is profit is just revenue minus expenses or income minus expenses. So we only recognize profit or revenue when it is earned and it can be reliably measured. And we earn our income and we earn our revenue when we sell the good or carry out the service. And this is not when the cash is received. So there are two main points. Cash has nothing to do with when we recognize revenue and income. Part of accrual accounting, which is something that you'll learn about or we'll cover in another lecture or lesson, is that accrual accounting states that you never recognize revenue or income when cash is received or they're independent of each other. You recognize revenue when you earn the revenue. And if you're selling goods, you earn the revenue generally when you sell the good. Or if you're a service organization, you earn the revenue when you perform the act of the service. As an example, if you're a bookkeeper and you're running a bookkeeping business, you may only collect payments from your clients on a quarterly basis. You may not actually scratch that. You may collect them more regularly than quarterly, but you may bill them at the end of the month, and you may give them 45 days to pay that invoice. So it may be more than 45 days from when you perform the service as to when you receive the cash for the payment. Now, the profit recognition principle says you recognize the income or the profit when you perform the bookkeeping service. So you would recognize it on the Monday and the Tuesday, the Wednesday, the Thursday, and the Friday when you were acting on their behalf, not when you collect the cash. You recognize the revenue when you perform the service. Something on top of that is that it has to be reliably measured. I just gave an example of a bookkeeper. If you're carrying out a bookkeeping service and you can't reliably measure the work that you're doing and can't put a transactional value, as we going back to the cost principle, and you can't put a value on that work, then you can't recognize the revenue either. So I dwelled a bit on when you on earning the revenue. It also has to be reliably measured, and by reliably measured, you have to know the value of it based on the cost principle. All right, the conservatism principle. This is the idea that you anticipate no profit and you anticipate all losses. There's kind of the running joke that the accountant is the negative one in the organization, or the one with the cranky mood, or the bad, or the bad, not bad attitude, but the negative one. It's based on this conservative principle, and as an accountant, you kind of have to be the cold shower for all the optimism in the organization. If everyone's too optimistic, it's too easy for optimistic valuations, optimistic income recognition, and other inaccurate data to bleed its way into the financial reports and the financial data. So you have to be very conservative in and remove the optimism in the way you record your information and the way you measure your results. If you anticipate no profit and anticipate all losses and keep that at heart, that's the sort of attitude you have to take. So you have to be 100% certain that you've earned a profit before you record it. And if you think you're likely to experience a loss, then recognize it early. As an example, you could be an accountant. The sales manager might come over to you and say, "Oh, listen, we've got a big contract with company XYZ. We really think that they're gonna sign the contract and buy and sign a big deal with us, and we're gonna recognize a bunch of revenue very, very, very soon. It's almost a dead certainty that we're gonna sign this contract with company XYZ." As an accountant, you shouldn't recognize that revenue at that stage. It's not good enough that the sales manager simply says, "Yeah, it's looking good. He's been saying all the right things so far." You would have to wait for company XYZ to sign the contract or to officially sign up and make sure it's 100% certain. Not 95% certain, not 97% certain, but it has to be 100% certain before you recognize revenue. About anticipating all losses, you may be working in a mining organization, a particular deposit in a region. You've been searching for a particular diamonds or something. I don't know. You've been mining for diamonds, and so far no diamonds have showed up in the mine. Everyone in the organization was saying, no, we're sure there are diamonds in the mine. We're sure there are diamonds in the mine. Nothing's shown up so far, but we're feeling pretty good. As the accountant, it's up to you to be conservative and say, listen, and recognize the losses on that mine that hasn't borne fruit. Anticipate no profit, anticipate all losses. That's the key phrase. All right, the final one. This is the going concern principle, and this is the idea that you assume the business has continuity for the foreseeable future. If you make that assumption, it adds to the reliability of the data. And by using the going concern principle, the values remain the most accurate with this assumption. The best way to explain this is with an example. Now, if you assume that the business is going to continue for the foreseeable future, that's one assumption. If we look at an extreme where we assume the business is about to go out of business, a lot of our valuations don't hold up anymore. So we talk about that office building that we reckon was worth $1 million at one stage. If we think we're going out of business next week, then I'm sure we would want to sell that office building very quickly, and we may accept much less than $1 million. The value in our accounting records might be $1 million, but if we're going out of business, we may sell it for $200,000. So by the idea that if we don't assume that the business is continuing into the future for the foreseeable future, our valuations can be kind of messed up. Also, at the other extreme, if we assume that the business is gonna go on forever or go into perpetuity, this kind of again contradicts the conservatism principle. We'd like the business to go to forever, but we're not being 100% conservative. If we make that assumption, very few businesses last for eternity. So we've got to take a happy medium between those, and we just make the assumption that for the foreseeable future, the business will continue, and our accounting information will hold up to the most scrutiny, and be the most reliable, and thus the most relevant for our decision making if we make that assumption. And they're the 7 accounting concepts. It's taking me longer than expected to explain. Thanks very much for listening. Get in contact if you need any clarification. I can't always say everything 100% in these lectures or lessons or videos, but if you get in contact, I can explain things a bit better. So thanks for listening.